Chapter 1 Rates and Returns. In this chapter, we will look at various ways in which interest rates can be interpreted, various components that form the interest rates, and some calculations related to present value and the future value. Then we look at various measures of return like the geometric return, arithmetic return, money weighted return, and the time weighted return. Then we look at some other measures of return and their applications. And at last, we look at the annualized return. Let us start directly with section 2, which is interest rates and time value of money. Let me ask you, if I give you an option to receive $9,500 today, or an option to receive $9,500 after a year, then what would you choose? Definitely anyone would say they would like to receive the money today. Now consider the second option. If I give you an option to receive $9,500 today, or an option to receive $10,000 after 1 year, then you might consider receiving the $10,000 after 1 year. So we can say the $500 that you are receiving extra is the compensation for not using the money today. $500 is the compensation for the sacrifice you are making today by not using this money. Now, when this compensation of $500 is stated in percentage terms, this is the interest rate. So how do we convert this to percentage? We simply take 500 divided by 9,500 and multiply by 100. So you get 5.26% as your interest rate. So 5.26% is the compensation for not receiving the money today. Hence, interest rate, also called as yield, denoted by R, is the required compensation in percentage terms for delaying the consumption of the money today. Interest rates can be interpreted in three ways. One is the required rate of return. It is the minimum return that the investor requires for accepting the money at a later time. This is what we have seen now. The second way in which interest rates can be interpreted is the discount rate. In the second option that I gave you, you had an option to receive $10,000 after 1 year, and the interest rate was 5.26%. Now if I were to ask you what is the value of this $10,000 at time 0, that is, what is the value of the $10,000 today, then we could use this interest rate to pull the amount back, to discount this amount back to time 0, and we would have got 9,500. So 5.26% can also be thought of as the discount rate. Throughout your CFA studies, you will find that interest rates and discount rates are used almost interchangeably. The third way in which you can interpret the interest rate is the opportunity cost. It is the value that the investor forgo by consuming today rather than saving. If you would have chosen to receive the $9,500 today rather than waiting until 1 year, then you would have lost the opportunity to earn the extra $500. So 5.26% interest rate can also be thought of as the opportunity cost. Now let us look at various determinants of interest rate. Interest rates are composed of various components, starting with the real risk-free interest rate and various premiums to compensate for different types of risk. Real risk-free interest rate is the interest rate on a completely risk-free security and assuming no inflation. We are assuming no inflation because we will be adding the inflation premium separately. The US T-bill can be considered as the completely risk-free security. Hence, the interest rate on US T-bill, that is, the US Treasury bill, can be considered as the real risk-free interest rate, assuming no inflation. Inflation premium compensates the investor for the expected inflation over the maturity of debt. As time passes by, the prices of goods and services increase. This is we refer to as the inflation. So to compensate the investor for the rise in price of goods and services, we add inflation premium. Default risk premium compensates the investor for the possibility that the borrower may fail to make the payment, or he may fail to make the payment at the contracted time. Suppose you lend money to two persons, A and B. A has a good reputation and there is very less chance that he will default on the payment. Whereas Mr. B has a chance that he might fail to make the required payments. He might default on some of the payments. So you charge Mr. A an interest rate of 5% and you charge Mr. B interest rate of 7%. The additional 2% reflects the default risk associated with Mr. B. So this 2% is the default risk premium. Coming to liquidity premium. Liquidity premium compensates the investor for the risk of receiving less than the fair value of an investment if such investment must be converted to cash quickly. Suppose you have a piece of land worth $1 million. You are in urgent need of cash and you have decided to sell this piece of land. It is very difficult for you to find buyer for this land immediately. And even if you find a buyer for this piece of land, there is a very high possibility that you might sell him at a price lower than $1 million. So the risk that you might receive less than the fair value of an investment if this piece of land or if the investment must be converted to cash quickly. So this risk is referred to as the liquidity risk and is compensated by the liquidity premium. Let us take another example. US Treasury bills have no liquidity premium because they are traded very frequently and they are traded in large amount. So you can find buyers at any time. You can sell and buy these treasury bills in large quantity without affecting its value. Whereas bonds of many small issuers are traded infrequently. This leads to high liquidity risk and such bond do provide with a liquidity premium. Coming to maturity premium, this compensates the investor for the increased sensitivity of the market value of debt to the change in market interest rate. We will study this when we go to fixed income. But for now, you understand that longer the maturity, higher will be the risk, hence the maturity premium will also be high. Whereas shorter the maturity, lower will be the risk and lower will be the maturity premium. Moving on, nominal risk-free rate. Nominal risk-free rate reflects the combination of real risk-free rate and the inflation premium. It is the addition of real risk-free rate and the inflation premium. For example, US Treasury bills or various other securities issued by the government are usually considered risk-free and The interest rate that they pay is the nominal risk-free rate. It is the combination of real risk-free rate and the inflation premium. These bonds or these bills also compensate the investor for the inflation premium. This is the nominal risk-free rate. If in the exam it is mentioned risk-free rate with no mention of whether it is real risk-free rate or nominal, you always assume that it is nominal risk-free rate. Let us look at an example. Exhibit 1 presents information for 5 debt securities. All investment promise only a single payment at maturity. Assume that premiums relating to inflation, liquidity and default risk are constant across all time horizon. As we can see that there are 5 investment. Their maturities are given. The liquidity and default risk is also given. Be careful over here. The liquidity here is the liquidity profile and not the liquidity risk. Investment 1 has high liquidity, which is a good thing. Therefore, it has low liquidity risk. Whereas investment 2 has low liquidity, which implies that it has high liquidity risk. So this is not the liquidity risk, rather the liquidity profile. Let us look at question 1. Explain the difference between interest rate offered by investment 1 and investment 2. As we can see, investment 1 and 2 have the same maturity. They have the same default risk. The only thing that differs among them is the liquidity. Investment 1 has high liquidity, whereas investment 2 has low liquidity. So as we have seen earlier, that investment having low liquidity should also provide you with high interest rate. So this is the case over here. Investment 1 having high liquidity provides you an interest rate of 2%. Investment 2 having low liquidity provides you with an interest rate of 2.5%. So the additional 0.5% is nothing but the liquidity premium. So the difference between the interest rate offered by investment 1 and investment 2 is nothing but the additional 0.5% to compensate for the low liquidity of investment 2. Let us look at second question. Estimate the default risk premium affecting all securities. Let us compare investment 4 and investment 5. Investment 4 and 5 have the same maturity, but they have different liquidity profiles and different default risk. First, let us make the liquidity profile of both these investment the same. Let us make investment 4 as a low liquid investment. So to compensate for this low liquidity, we need to add liquidity premium to the interest rate. We know from question 1 that the liquidity premium is 0.5%. So the new interest rate is 4.5%. Now investment 4 and 5 have the same maturity. They have the same liquidity profile. The only thing which is different is the default risk. Investment 5 has high default risk, and to compensate for this high default risk, the interest rate should also be high. As we can see, investment 4 having low default risk is having a low interest rate, and investment 5 having high default risk have high interest rate. The additional interest rate of 2% is nothing but the default risk premium. So the default risk premium affecting all security is 2%. Question 3. Calculate the upper and lower limits for the unknown interest rate for investment 3, represented by R3. For investment 3, the interest rate is not given, and we need to find the upper and lower limits for the interest rate. Comparing investment 2 and investment 3, we can see that they have the same liquidity profile and the same default risk. The only thing which is different among them is their maturity. As we have seen earlier, that investment having high maturity have high risk. Therefore, they provide you with more interest rate. Hence, we can say that the interest rate on investment 3 should be greater than interest rate on investment 2 to reflect the higher maturity of 5 years. So the lower limit of interest rate on investment 3 should be 2.5%. Now let us compare investment 3 and investment 4. Both these investments have the same default risk, but their liquidity profiles and maturities are different. Now let us make the liquidity of investment 4 as low. And to compensate for this low liquidity, we add a liquidity premium of 0.5% and we get the new interest rate of 4.5%. Now comparing investment 3 and 4, the liquidity profile and the default risk are the same, but the maturities are different. Investment 4 having high maturity compared to investment 3 should also provide you with higher interest rate. So we can conclude that the interest rate on investment 3 should be lower than 4.5% to reflect the shorter maturity. Hence, the interest rate on investment 3 should be lower than 4.5%. So these are the upper and lower limits for R3. Moving on, section 3, rates of return. Financial assets usually provide two types of return: income and capital gain or capital loss. If you purchase stocks, then stocks provide you with dividends, and in case of fixed income instruments, they provide you with periodic income of interest. So this is the income part. And say you purchased the stock for $70 and you sold it for $85. Then the additional $15 you have earned is the capital gain. So financial assets usually provide two types of return: the income part and the capital gain or capital loss. Having said that, not all financial assets provide these two types of return. Some assets like annuity instruments and defined benefit pension plans, they just provide you with regular income. There is no capital gain or loss associated with such instruments. Whereas some instruments like non-dividend paying stock, these stock don't pay any dividend. So the only way for the investors to earn return is through capital gain. In this section, we will look at four types of return: the holding period return, the arithmetic mean return, the geometric mean return, and the harmonic mean return. Let us look at the first return, the holding period return. Holding period return is the return earned from holding an asset for a specified period of time. Suppose you purchase an asset today, that is at time 0, and you sold the asset after 7 weeks. Then the holding period in this case is 7 weeks, and the return that you have earned during this period is your holding period return. Now say you purchased an asset today and you sold the asset after 9 years. then the holding period in this case is 9 years, and the return you have earned during this period of 9 years will be your holding period return. Hence, we can say that the period could range anywhere between 1 day, 1 week, many months, years, and so on. Now let us see how do we calculate the holding period return. Say you purchase an asset today, that is at time 0, for $100, and after 3 months you sold the asset for $115. The holding period in this case is 3 months, and the holding period return is 115 minus 100, that is 15, which is your capital gain divided by 100. This should give you 0.15. You can also write it in percentage terms, which will be 15%. So this is your holding period return. Let us look at another example with a slight variation to it. Suppose you purchase a stock today for $50, and at the end of 6 months you sold the stock for $53, and also at the end of 6 months you received a dividend of $2. So in total you received $55. The holding period return in this case will be 53 minus 50, which is your capital gain of $3, plus the $2, which is your dividend, divided by 50. This should give you holding period return of 10%. This is the formula of holding period return. The holding period return is denoted by capital R. P1 is the price of the asset at the end of holding period. In our case it was $53. P0 refers to the price of the asset at the beginning of the holding period, which was 50, and I refers to the income at the end of the holding period. Income could be dividend, income could be interest, or any other form of income. In our case it was $2 divided by P0. There is a note here that for ease of illustration, the CFA Institute assumes that the income will be received only at the end of the holding period. It is possible that in practical life, the income could be received somewhere in between the holding period, but the reinvestment rate also comes into picture. So to avoid the complication, we assume that income will always be received at the end of the holding period. Let us look at an example. An investor purchased 100 shares for $34.5 per share at the beginning of the quarter. If the investor sold all the shares for $30.5 per share after receiving a total of $51.55 as dividend at the end of the quarter, what is the investor's holding period return? So at the beginning of the quarter, the investor purchased total of 100 shares for $34.5. So his total investment was $3,450, and at the end of 3 months, he sold all his 100 shares for $30.50, which was $3050, and he also received $51.55 at the end of the quarter. So the holding period return is 3050 minus 3450 plus the dividend of $51.55 divided by 3450. You should get 0.101, which is 10.1%. So option C is the correct answer. Sometimes we also need to calculate the holding period return from 2 or more annual returns. Suppose an investor held an asset for 2 years. That is, he sold an asset after 2 years. During year 1, he earned a return of 10%. and during year 2, he earned a return of 12%. Now let us see how do we calculate the holding period return from this data. Let us assume that he invested $100 at the beginning. So the value at the end of year 1 will be 100 plus 10%, which will be 110. Now on this value of 110, he earned a return of 12% during the second year. So the value will be 110 plus 12% of 110, which will be 123.20. Now we have the beginning value and we have the end value. Now it is easy for us to calculate the holding period return, which will be 123.20 minus 100 divided by 100, which will give us 0.2320, which is nothing but 23.20%. Now let us see if we can derive a formula for this. Continuing with the same example, he earned a return of 10% and then 12%. Now suppose instead of investing $100, he invested just $1. So the value at the end of year 1 will be 1 plus 10%. 1 plus 10% of $1. This is your interest. I can also write this as 1, taking 1 as common, in bracket 1 plus 10%. I hope you get this. So this is the value at the end of year 1. Now on this value, he earned a return of 12% during the second year. So the value at the end of second year will be 1 bracket 1 plus 10% plus interest of 12% on 1 bracket 1 plus 10%. Now again, taking this amount, which is 1 bracket 1 plus 10% as common, I can write the above equation as follows. Taking this as common, I will write 1 plus 12%. Now if you see, if we solve this equation, we have 1 multiplied by 1 plus 10%, which is 1.11, 1 plus 12%, which is 1.12, and you subtract 1 from this. What will you get is, you multiply 1.1 by 1.12. You should get 1.2320 and subtract 1, and you will get 0.2320, which is nothing but 23.20%. You see, the answers are the same. So the formula for calculating the holding period return is this: 1 plus return of the year 1 multiplied by 1 plus the return of the year 2, 1 plus the return of the year 3, and so on, and subtract 1 from it. In our case, the return for the year 1 was 10%, return for the year 2 was 12%, and there was no year 3. And we subtract minus 1 from it. We get 1.2320, and we subtract 1. We get 23.20% as the answer. So this is the formula. Let us look at an example to have a better understanding of this. An analyst obtains the following annual rate of return for a mutual fund. During year 1, the return was 14%, then negative 10% for year 2, and negative 2% for year 3. What is the fund's holding period return over the 3-year period? Let me draw a timeline. During year 1, the fund earned a return of 14%. During year 2, negative 10%, and then negative 2%. So using the formula, we get 1 plus 14% multiplied by 1 minus 10% multiplied by 1 minus 2%, which is 1.14 multiplied by 0.90 multiplied by 0.98. We will get 1.0055. and subtract 1 from this, we will get 0.0055, which is 0.55 percentage. So the holding period return for the 3-year is 0.55 percentage. Let's look at the second return, the arithmetic mean return. Holding period returns can be reported on a daily basis, monthly, quarterly, or on an annual basis. In the previous example, the investor held the asset for 2 years and he earned 10% and 12%. The holding period was 2 years, but the returns were reported on annual basis. Say it was investor A. Now we have another investor, investor B, who held some different asset for 3 years and he earned 9%, 15% and 11% during his 3-year holding period. Now in order to compare which investor has performed better, simply comparing the holding period return would not be fair because investor B has a longer holding period. Therefore, he will have a larger holding period return compared to A. Hence, we need to average out the returns and then compare the average returns in order to see which investor has performed better. Hence, it becomes necessary to normalize or average out the return to a common period for ease of comparison. We will look at two such ways of averaging returns: arithmetic mean return and the geometric mean return. Arithmetic mean is represented by R bar subscript I. I represents the particular asset. Suppose a particular investor has invested in asset I and he held the asset for 3 years. During year 1, the return was negative 50%. During year 2, the return was 35%. And during year 3, it was 27%. To find the arithmetic mean, we simply add the returns and divide it by 3. And you should get the arithmetic mean return of 4%. Now let us look at the second way of averaging the returns, which is the geometric mean return. Geometric mean provides more accurate representation of the average return earned over a period of time than the arithmetic mean return. This is because geometric mean return considers the compounding of returns. Continuing with our previous example, during year 1, we earned a return of negative 50%, then 35% and then 27%. Now consider we have invested $100. So the value at the end of year 1 will be 100 minus 50%, which is $50. Value at the end of second year will be 50 plus 35%, which will be 67.5. And value at the end of year 3 will be 67.5 minus 27%. 67.5 plus 27%, which will be 85.7250. So this is how much we have earned at the end of year 3. Now the arithmetic mean return that we calculated earlier told us that the average return we earned per year is 4%. So let us put that figure over here. 4% in year 1, 4% in year 2 and 4% in year 3. $100 at the beginning. So the value at the end of year 1 will be 104. Then we have 108.16. Then we have 112.4864. Now if you compare the actual value versus the value we got using the arithmetic mean, there is a huge difference. Why? Because arithmetic mean did not consider for the compounding of returns. Now let's see what will be the value using geometric mean return. First, let us see how do we calculate the geometric mean return. If you remember the formula for calculating holding period return from multiple annual returns, we will be using the same formula over here. 1 minus 50% multiplied by 1 plus 35% multiplied by 1 plus 27%. So this is the holding period return for the 3 year. Now we want to find the average return, that is return per year. So we will take the cube root of the entire figure and then subtract 1 from it. The cube root can also be written as 1 minus 50% is 0.5, then 1.35 and 1.27. The cube root can also be written as 1 divided by 3 and then minus 1. Now how do you do this on your calculator? You first multiply these three figures, which is 0.5 multiplied by 1.35 and then 1.27. Press equals to. Then what you need to do is press this key, y raised to x, and then press the open bracket. Then do 1 divided by 3 and then close the bracket. The answer you are getting on the screen is the result for 1 divided by 3. And now press equals to, which should give you the answer for this entire figure. And now press minus 1 and you will get negative 0.05, which is negative 5%. So according to geometric mean calculation, the average return is negative 5%. Now let's put this figure and see what value do we get. So negative 5% during year 1, negative 5% during year 2 and negative 5% during year 3. $100 at the beginning. Value at the end of year 1 will be 100 minus 5%, which is 95. Then 90.25 and then 85.7375. Now see, the actual amount at the end is very similar or almost same to the value we got using geometric mean return, because geometric mean considers the compounding of returns, whereas arithmetic mean don't. Now let's see if we can derive a formula for this. So the formula is 1 plus year 1's return multiplied by 1 plus year 2's return and so on until 1 plus the last period's return. Now instead of writing cube, instead of writing this root, we can also write it as 1 divided by n and minus 1. Now let us look at an example. An analyst observes the following annual rate of return for a hedge fund. During year 1, 22%, then negative 25% and then 11%. What is the fund's geometric mean return over the 3-year period? So using the formula, we have 1 plus 22%, which is 1.22, multiplied by 1 minus 25%, which is 0.75, multiplied by 1 plus 11%, which is 1.11, raised to 1 divided by 3, minus 1. I hope you know how to do this. You should get 1.0052 minus 1, which is 0.0052, which can also be written as 0.52%. So option A is the correct answer. Just like we did on the previous slide, we compare the actual value against the value calculated using the geometric mean return. Here also you can calculate the actual value at the end of 3-year period and compare it with the value at the end of 3-year period you got using the geometric mean. You should find the values are the same. Hence, geometric mean return is more accurate than the arithmetic mean return. Arithmetic mean is always greater than the geometric mean. In this example, we are given country A to country I's return for 3-year period, and their arithmetic mean return and geometric mean return is also given. If we see that arithmetic mean return is always greater than the geometric mean return, 0.23 greater than 0.15, negative 1.33 is greater than negative 1.38. The absolute numbers are greater, but because it is negative, 1.33 negative is greater than negative 1.38. And so is the case in the remaining scenario. But there is one exception to this rule. When there is no variability between the observation, that is, say the 3 years return are 10%, 10% and 10%. Then the arithmetic mean return will also be 10% and the geometric mean return will also be 10%. So when there is no variability between the returns, both means will be equal. And when the variability between the observation is high, the difference between the means will also be high. Suppose you held an asset for 1 year and during that year you earned a return of 10%. If you want to report what is the return that you have earned during 1 year, you would simply tell 10%. There is no need to find an average. There is no need to find the arithmetic mean or the geometric mean because we only have one observation over here. Hence, when we want to report the average historical return only of a single period, then using arithmetic mean or geometric mean does not matter because both will be same. But if we want to report the average historical return earned over a multiple period, then geometric mean return is a preferred measure. As we have seen earlier, when we earned a return of negative 50%, 35% and 27%. If we want to report the average return that we have earned during this 3-year holding period, then using geometric mean return, we got negative 5% as our answer. And using arithmetic mean, we got 4% as our answer. And we found out that geometric mean return provided a more accurate picture. Hence, when reporting average historical return over multiple period, geometric mean return should be used. Now, when we want to estimate the average return over 1 year period, arithmetic mean return is a preferred measure. For example, suppose in the past 2 years, you earned a return of 100% in the first year and negative 50% in the second year. Say you invested $100. Then at the end of year 1, the value will be 200. And at the end of year 2, the value will be 100. Now if you want to forecast what will be the average return for next 1 year, then using arithmetic mean, we will get 25% as our answer. And if we find the geometric mean, we will get the geometric mean return to be 0%. So as you can see, it is much appropriate to use arithmetic mean return to forecast the return for a single period. And when we want to estimate the average return over multiple period, then geometric mean return is the preferred measure because geometric mean return captures the geometric mean return considers the compounding effect which occurs over multiple period. Now, we will look at the fourth mean, which is the harmonic mean. Harmonic mean is a special type of mean in which an observation's weight is inversely proportionate to its magnitude. Let us understand this by looking at the formula. Suppose we have 4 observations, 3, 5, 7 and 12. In order to find the harmonic mean, we take reciprocal of each of the observation and add the reciprocal of the observations. Then we divide this entire sum by number of observations. In our case, we have 4 observations. Hence, we divide this entire sum by 4. Let us look at the formula. Harmonic mean is represented by x bar h, and it is equal to n, which is the number of observations, divided by summation of the reciprocals of the observations. Each observation is represented by xi. 1 by x is the reciprocal, and summation of the reciprocal of this observations is our denominator. Now let's see how do we perform this entire function in our calculator. Without writing anything down, we can directly calculate this using our calculator. You press 3 and then press 1 by x. Now directly press this plus button, then press 5 and press 1 by x, and then press again the plus button. Similarly, press 7, press 1 by x and then plus button, and press 12, 1 by x and plus button. Now press equals to, and you should get 0.7595. This 0.7595 is the sum of all these observations. Again you press 1 by x and you should get 1.3166. So this 1.3166 is the value for 1 divided by 0.7595. And now multiply this by 4. We should get the answer for this entire thing. So as you can see, without storing anything, without writing anything down, we have calculated this entire expression using 1 by x function. Harmonic mean is very rarely used to calculate the average return. Rather, it has various uses, like it is very useful when we have large outliers in the data. For example, if I want to find out the average height of the students in a classroom, and suppose I have 4 students in my classroom whose heights are 100 cm, 120 cm, 130 and 150. The arithmetic mean will be 100 plus 120 plus 130 plus 150 divided by 4, which will be 125 cm. And the harmonic mean will be the sum of the reciprocals of these observations and the entire sum divided by 4. I hope now you know how to perform the harmonic mean calculations. So the harmonic mean will be 122.3529. Now let us say we have the 5th student whose height is 2000 cm hypothetically. Now the arithmetic mean will be 500 cm. Now let us calculate the harmonic mean, and we will get the harmonic mean to be 150.6373. As you can see, just by this one extreme large observation, the average height according to the arithmetic mean has increased from 125 to 500 cm. Arithmetic mean is heavily influenced by this large outlier, whereas harmonic mean is not much influenced by this large outlier. Hence, harmonic mean is useful to find the average of the observations when we have large outliers in the data. Another important application of harmonic mean is cost averaging. Suppose you make fixed investment every month at the beginning of every month. Suppose you invest $5,000 at the beginning of every month and you did it for 3 months. You purchased a stock of a particular company. So when you made your first purchase, the price was $50. When you made your second purchase, the price was $75. And when you made your third purchase, the price was say $40. So to find the average price, that is, to find the average price per asset, average cost per asset, when we make fixed periodic investment, we use harmonic mean. And this is called as cost averaging. Let us look at an example to understand this in a better way. Suppose an investor invests 1000 euros each month in a particular stock for 2 months and the share prices were 10 euros and 15 euros at the two purchase date. What is the average price paid for the security? If you simply take 10 plus 15 divided by 2, which is 12.5, the answer will be wrong. Now let's try to find the average price without using the harmonic means formula. The average price simply will be the total investment that we make divided by the number of shares that were purchased. So the total investment is 1000 euros plus 1000 euros, which is 2000 euros divided by number of shares. During the first purchase, we invested $1000 and the price was 10. So the number of shares we purchased were 100. When we made the second purchase, the price was 15. So the number of shares we got was 66.67. So the total number of shares we purchased were 166.67 and the average price we paid was 11.99 euros per share. And if we use the harmonic formula, the harmonic means formula, we will still get the same answer. Let us see. Harmonic means formula is n divided by the reciprocals of the observations. In our case, we have two observations, which is 10 and 15. So 2 divided by the sum of the reciprocals of the observation, which is 1 by 10 and 1 by 15, which will give us 12 euros. So as you can see, the answers are the same. So this is one major application of harmonic mean, where we use the harmonic means formula to find the average price paid for the security. So now let us look at some of the relationship between the three means. Arithmetic mean is always greater than geometric mean, and geometric mean is always greater than the harmonic mean. We can also arrive at the following relationship between the three means, where arithmetic mean multiplied by the harmonic mean equals to the geometric mean squared. Let us look at this example over here. Each year in December, a securities analyst selects her 10 favorite stocks for the next year. In the following exhibit, we are given the PE ratios, that is, the ratio of share price to the projected earnings per share for the top 10 stock picks. I hope you are comfortable with calculating all the three means. So what I want you to do is calculate the arithmetic mean, harmonic and the geometric mean of all these 10 P's. And you can verify these relationship by yourself, whether it holds true or not. One thing about the calculation of geometric mean is, when we used to calculate the geometric mean for the returns, what we used to do was, we take 1 plus the return, multiply by 1 plus the return of second period and take the root of the entire figure. But while calculating the geometric mean for ratios, we directly take the ratios. We do not add 1 to it. So in this case, we will take 22.29 multiplied by 15.54 and so on until 8.35. And then we will take 1 by 10 of this entire figure. And the answer you will get will be your geometric mean. So calculate all the three means for the 10 price to earnings ratio and verify these relationship by yourself. Now let us see, when the observations have some outliers, how do we deal with such outliers? Continuing with the previous example which we had taken in harmonic mean. Suppose we have 4 students in a classroom whose heights are 100 cm, 120 cm, 130 and 150. The arithmetic mean of these 4 students' height is 125 cm. Now we have a new addition to the classroom, a new student whose height is 2000 cm. Now the arithmetic mean of the classroom height goes up to 500 cm. So as you can see, just because of this one large outlier, the arithmetic mean has increased significantly to 500 cm. And this new arithmetic mean is not the accurate representation of the student's height. Not just the large outliers, even when we have small outliers, they also tend to distort the arithmetic mean. Say the 5th student's height was just 1 cm. Now the arithmetic mean of the 5 students' height would have gone drastically down, which again would not have been the accurate representation of the classroom height. So arithmetic mean tends to get distorted when the data contain outliers. And we have certain methods to deal with such outliers. Harmonic mean can be used when we have large outliers, but when we have small outliers, harmonic mean is not that useful. We also have 2 other methods to deal with the outliers, which is trimmed mean and Windsorized mean. In trimmed mean, what happens is, we remove a specified percentage of small as well as large outliers. Suppose we have 300 observations with us and we decide that the lowest 10% of the observation and the highest 10% of the observation are outliers. And we want to remove these outliers. So we have 30 small outliers and 30 large outliers. And we are left with 240 observations. Now we just add up these 240 observations and divide them by 240. And we get the arithmetic mean, which is referred to as the trimmed mean. This is one way of dealing with the outliers, where we simply remove the observations and calculate the mean from the remaining observations. The second way to deal with the outliers is the Windsorized mean. Instead of removing or deleting the outliers, this method replaces the specified percentage of small and large outliers with the nearest observation. Say we have 300 observations and we decided to replace the top 10% of the observations and the lowest 10% of the observations. These are 30 observations and 30 observations. We decided to replace the 30 observation by the observation which lies just on the boundary. And similarly, we decided to replace the 30 large observation by the observation which is lying just on the boundary. Suppose this observation is x and this is y. So how do we calculate the Windsorized mean? We take x, we add it for 30 times, and then we add the remaining 240 observations, then we add this observation for 30 times again. And we divide the entire sum by the number of observation, which is 300. And we get our Windsorized mean. So these are the 2 ways in which we can deal with the outliers. Concluding with the section on means, when we want to include all the observation including the outliers, then we may calculate arithmetic mean of the observations. But if there is a compounding effect, then we might prefer using the geometric mean. Or if we want to remove the effect of the outliers, then we might use harmonic mean, trimmed mean, or Windsorized mean. So these are the 5 means that we have seen. The arithmetic return did not consider the compounding effect, whereas the geometric mean did consider the effect of compounding. But both these mean do not account for the cash inflows as well as the cash outflows from a portfolio. Hence, we need a measure which accounts for the cash inflows as well as the cash outflows. So money weighted rate of return is such measure which considers the impact of cash inflow and cash outflow. Money weighted rate of return is very similar to the internal rate of return or the yield to maturity. You will learn about these in the future learning modules. Cash inflow refers to the amount returned to the investor or the amount withdrawn by the investor or the money which is remaining at the end of the investment. Whereas cash outflow refers to the amount invested by the investor. We should look at cash inflow and cash outflow from the perspective of the investor. Let us look at an example as to how money weighted rate of return considers the impact of cash inflow and cash outflow, and how does this rate of return differs from the arithmetic return and the geometric return. Continuing with the previous example, where in the year first we earned negative 50% return, then 35% and then 27%. Now assume that the investor invests 100 euros at the beginning of year 1, 950 euros at beginning of year 2, and he withdraws 350 euros at the end of year 2. Beginning of the year 1 is the same as time 0, beginning of year 2 is the same as end of year 1, and end of year 2 is the same as beginning of year 3. So at the beginning of year 1, there is no balance in the portfolio. The investor invests 100 euros at the beginning of year 1. So the net balance at year beginning was 100 euros. During the year 1, the portfolio earned a return of negative 50%, which led to a loss of 50 euros. And there is no withdrawal by the investor at the end of the period, that is at the end of year 1. So the balance in the portfolio is 50 euros at the end of year 1. Coming to second year, carrying this balance forward to the second year, the balance at the beginning of second year is $50. The investor made additional investment of 950 euros at the beginning of year 2. You can also consider this additional investment made at the end of year 1. Both are the same. Hence, the net balance at second year's beginning is 1000 euros. During year 2, the return was 35%. So on $1000, the portfolio earned a return of $350. Investor withdrawn the $350 at the end. So the portfolio is left with 1000 euros. Carrying this balance forward, the balance at the beginning of year 3 is 1000 euros. There is no additional investment. The net balance is 1000 euros. The portfolio earns 27% return, and in absolute terms, in euro terms, it is $270. There is no withdrawal also. So the balance at the end of year 3 is 1270. So I hope the timeline as to when the cash flows occurred is clear to you. Now before looking as to how we will calculate the money weighted return, I will give you a simple example to understand what money weighted return is. Suppose I invest $100 at the beginning, that is today, and after 1 year I received $110. So we can say that I have earned a return of 10%. Now let us try to find out the present value of 110 at time 0, that is today. So in order to find the present value, we need to discount 110 amount back to time 0. So how do we do it? We take 110, we divide it by 1 plus some discount rate, which should give us $100. So let me take 5% as the discount rate. So if I take 5% as the discount rate, I will get 104.76, which is not the same as $100. Now let me take 15% as the discount rate. Then the present value will be 95.65, but we should get $100 as our present value. Hence, 15% as the discount rate is also the incorrect answer. Now let me take 10% as the discount rate, which will be 1.1. This should give us the present value of $100. So we can say that the discount rate, which makes the future value equals to the present value, is our interest rate, right? The discount rate, which makes the future value equals to the present value, is the interest we have earned on the investment. Taking this a step further, because the investor had invested 100 euros initially, which is his cash outflow, I can write it as negative 100 euros, and he received 110 at the end of year 1, and the present value is 110 divided by 1 plus 1.1. Let us add these two figures. We get negative 100 plus positive 100, which is 0. So I can say the discount rate, which makes sum of the present value equal to 0, is the interest rate we earned on the investment. Listen to this carefully. The discount rate, which makes sum of the present value of all the cash flows equal to 0, is the interest rate that we have earned on the investment. So this is what IRR is. You can also refer to it as interest rate, discount rate, or the money weighted rate of return. So IRR, or the money weighted rate of return, is the discount rate at which the sum of the present value of cash flow is 0. So the interest we earn on an investment is the discount rate at which sum of the present value of all the cash flow is 0. It is represented by the following formula, where we find the present value of all the cash flows, sum them up, and the discount rate, which makes this sum equals to 0, is the interest rate we earned on the particular investment. Now let us see in this example, how do we calculate the money weighted rate of return. So CF0, that is cash flow at the beginning of year 0, plus cash flow 1, that is cash flow at the end of year 1 or at the beginning of year 2. We should find the present value of this. Hence, we divide it by 1 plus discount rate raised to 1. Then cash flow 2, which is cash flow at the end of year 2 or cash flow at the beginning of year 3. We divide it by 1 plus r square to find the present value. Then we have cash flow 3, that is cash flow at the end of year 3, 1 plus r cube. Sum of all these present values should be 0, and the discount rate, which makes sum of all these present value equals to 0, will be the interest rate we earned on this investment. So first let us find out the cash flows. Let us determine what the cash flows are. Cash flow 0, that is cash flow at time 0. At the beginning of year 1, investor had invested 100 euros and there is no other investment at the beginning. Hence cash flow 0 is negative 100. Because it is a cash outflow from the investor's perspective, we represent it by negative. CF1 refers to cash flow at the end of year 1 or at the beginning of year 2. At the end of year 1, there is no withdrawal by the investor. At the beginning of year 2, we see that investor had invested additional 950 euros. This is a cash outflow from the investor's perspective. Hence, cash flow 1 is negative 950 euros. Coming to cash flow 2, there is withdrawal by the investor, which is cash inflow. Hence, we represent this by 350 euros. And there is no additional investment. Hence, the cash flow at the end of year 2 or at the beginning of year 3 in total is $350. Cash flow at the end of year 3. We see there is no withdrawal nor is there any addition by the investor. But as we have seen that cash inflow also refers to any value remaining at the end of investment. So cash flow 3 is 1270. By inserting all these figures and by using the trial and error method, we get R, which is the internal rate of return. Doing it manually takes a lot of time. So on the calculator, we have a function for it, which directly gives us the internal rate of return or the money weighted rate of return. What you need to do is, first ensure that all the data is cleared. You press the CF key over here, then press second and this key. This ensures that any previous data is cleared from the calculator. Then you will see CF0 on the screen. You press 100 and then press this key, plus minus key, and then press enter. The value gets stored. Then press the down arrow key and you will see C01, which is nothing but the cash flow 1. You enter 950, press the plus minus key, then again press the enter and press the down arrow key. Then you must see something as F01, which refers to frequency of this cash flow. How many times did this cash flow occur? Which is how many times the 950 euros has repeated. In our case, it has repeated only once. So by default, the frequency will be shown as 1. You do not need to make any changes to it. Press this down key again, you will see C02. Press 350 and then press enter. Then again, you press down key, you will see F02, which is the frequency of the second cash flow. This cash flow again has occurred only once and the default frequency is also 1. You do not need to make any changes. Press the down arrow key, then C03. You enter 1270, press enter and down arrow key. Now press the IRR key and then press CPT. You should get the IRR to be 26.1088%. So this is the actual return that the investor has earned on his investment, considering the cash inflows and the cash outflows. If you remember that the geometric mean that we got on the same calculation was negative 5%. You see there is a huge difference between the geometric mean and the money weighted return. This is because when the portfolio had earned a negative 50% return, the investor had only 100 euros invested in the portfolio. But when the portfolio performed well in the second and third year, there was a higher sum invested in the portfolio. Investor had invested additional 950 euros at the beginning of year 2. So this 35% was earned on a higher sum, which led to a higher rate of return. So this is how money weighted rate of return considers the impact of cash flows and deals with the actual rate of return that the investor earns. Let us solve an example related to money weighted rate of return. At time 0, an investor buys one share at a price of $200. At time 1, he purchases an additional share at a price of $225, and at the end of year 2, he sells both the shares at a price of $235. During both the years, the stock pays a dividend of $5 per share. Let us draw a timeline to understand the cash inflows and outflows. At time 0, he purchased a share for $200. So, time 0 there was a cash outflow of $200 and there were no other cash flows. Coming to end of year 1, he received a dividend of $5 per share, and at the end of year 1, he only had 1 share. So there is a cash inflow of just $5 as dividend. He purchased an additional share for $225, which led to a cash outflow of negative $225. Coming to the end of year 2, he received dividend on 2 shares at $5 per share. So in total he received $10 as dividend. He also sold both the shares for $235. So the cash inflow was $470. So CF0 is negative 200, CF1, we get the CF1 by combining these two figures, which is negative $220. CF2, again we combine these two to get CF2, which is positive 480. Now enter all these figures, all these cash flows into your calculator. Press IRR and then press compute. You should get the IRR, that is the money weighted rate of return, to be 9.39%. This is the return that the investor actually earned on his investment, considering the cash flows. I want you to try this example by yourself. You need to calculate the holding period return, the arithmetic mean return, the geometric mean return, and the money weighted return. You can pause the video and solve for the 4 questions. Okay, the answer for question 1 is 42.35%. The arithmetic return is 7.6%. The geometric return is 7.32%, and the money weighted return is 5.86%. I hope you have got all the 4 answers correct. Moving on, we have time weighted rate of return. One of the problems of using money weighted rate of return is it might not be appropriate in some situations, like evaluation of a portfolio manager's performance. Suppose we have a mutual fund manager who is managing money on behalf of lots of investors, and say the mutual fund manager has delivered the following returns. Now say we have 2 investors. We have investor 1 who made the following cash inflows and outflows during the 3 year. In year 1 he invested 100 euros at the beginning, then there was no withdrawal during the first year. He invested 950 euros again at the beginning of year 2, and he withdrawn 350 euros at the end of year 2, and there was no addition or withdrawal during the 3rd year. Based on this information, we calculated the money weighted return to be 26.11%. Now we have another investor who have the following cash flows. Say he invested 10,000 euros at the beginning of year 1. He withdrawn 4,000 euros at the end of year 1, and there was no cash addition or withdrawal during the 2nd year. And he added 2,000 euros again at the beginning of year 3. Based on this information, we get the money weighted rate of return to be 19.3%. We have the same mutual fund manager who has delivered the following returns, but just because the investor added and withdrawn different amounts of money at different time, the money weighted rate of return is different. So evaluating a portfolio manager's performance becomes difficult with money weighted rate of return. If a client gives a portfolio manager more funds to invest at an unfavorable time, then the manager's money weighted rate of return tends to be depressed. Whereas, if a client adds fund at a favorable time, then the return tends to be elevated. So in order to remove these effects, we have time weighted rate of return. The time weighted rate of return removes these effects and provides an accurate measurement of manager's performance. Now let us see how do we compute the time weighted rate of return. Broadly, there are 4 steps involved. The first step is to break the overall investment period into sub-periods based on the cash inflows and outflows that have occurred due to investors' action. The second step is to value the portfolio immediately prior to any cash inflows or outflows which have occurred due to investors' action. Then calculate the holding period return for each sub-period. Link the holding period returns of the sub-period to find the annual return. Let us look at an example to understand it. Continuing with the previous example, where at time 0, investor purchased one share for $200. At time 1, he purchased an additional share for $225. At the end of year 2, he sold both the shares for $235 per share. And during both the years, he received $5 per share as dividend. Let us draw a timeline to understand the cash flows. At time 0, there was a cash outflow of $200. Then, at the end of year 1, he received $5 as dividend. He also purchased share for $225. Then, at the end of year 2, he received dividend on 2 shares, which was $10. And he sold both the shares for $470. Now let us break this entire investment period of 2 years into sub-periods based on the cash flows. So our first sub-period starts from time 0 and it ends at the end of year 1. At the end of year 1, the investor purchased a share for $225. So our sub-period ends right before the investor purchased the share. So this is our first sub-period. Our second sub-period starts immediately after the investor made the cash outflow of $225. So it starts right at the end of year 1 or at the beginning of year 2 and ends at the end of second year, where he sold both the shares for $470. Now we broke the entire investment period into 2 sub-periods. Now let us value the portfolio at the beginning and at the end of each sub-period. At the beginning of first sub-period, we had 1 share in it. So the value of the portfolio was $200, and at the end of year 1, we still have 1 share in our portfolio. So value of that 1 share is $225. And we also received $5 as our cash flow. So the value is $230. Now value at the beginning of second sub-period, that is value immediately after this additional share was purchased. Now our portfolio has 2 shares whose values are $225 multiplied by 2, which is $450. And value at the end of second sub-period is 2 shares where each share is worth $235. And we also received $10 as our dividend. So the total value is $480. You should not consider the dividends, the cash inflows of dividend, for the purpose of dividing the investment period into sub-periods, because we are only concerned with those cash flows which occur due to investors' action. The cash flow, that is the dividends, will be the same for all the investors who are invested in one fund. Hence, we divide the investment period into sub-periods based on the cash flows which have occurred due to the investors' action. Now moving on to the third step, we calculate the holding period return for each sub-period. So for the first sub-period, the holding period return is 230 minus 200 divided by 200, which is 15%. The holding period return for second is 480 minus 450 divided by 450, which should give us 6.67%. Now from these 2 holding period returns, let us calculate the annual returns. So using the geometric mean, we take 1.15 multiply by 1.067 and then 1 by 2 minus 1. You should get the time weighted rate of return to be 10.76%. If you remember, for the same example, we calculated the money weighted rate of return and it was 9.39%. So the difference in time weighted rate of return and the money weighted rate of return is due to during year 1 when the portfolio earned 15% return. The investor had only one stock in it, but when the portfolio performed relatively poor, when it earned just 6.67%, the investor had two stocks in the portfolio. Hence, the money weighted return was depressed, but the time weighted rate of return removed these effects of cash flows and gave us a return of 10.76%. Let us look at the following example. Stubbeck Corporation sponsors a pension plan for its employees. It manages part of the equity portfolio, that is, the pension fund, in-house, and it delegates the remaining balance to a super trust company. As the Chief Investment Officer of the Stubbeck Corporation, we are required to review the performance of the in-house management and the super trust portfolios over the last 4 quarters. And the amount invested at the beginning is the amount each portfolio manager is responsible for investing. So we have a pension fund and the pension fund is managed. Some part of it is managed in-house and some part of the fund is managed by a third party, which is super trust company. And we are required to review who has performed better. So in-house management is responsible for managing 4 million of the entire pension fund. We are required to calculate the time weighted rate of return for the in-house account. So as I read the information, I will also draw a timeline to divide the sub-periods. So our first sub-period starts at the beginning of first quarter and the value of portfolio is 4 million. Now let us see when does the next cash flow occur. The cash flow occurs at the beginning of the first quarter. This is a cash inflow. So the value right before this cash inflow is 4 million. This is our first sub-period. Our second sub-period starts right after this cash flow was made. So the value of the portfolio right after this cash inflow of 1 million was made is $5 million. Now let us see when does the next cash flow occur. The next cash flow occurred at the beginning of second quarter. So let us see what is the value of the portfolio just prior to the cash outflow. It is 6 million. Our third sub-period starts right after this cash outflow and the value of the portfolio is 5.5 million. Similarly, the next cash flow occurred at the beginning of third quarter and the value immediately prior to it was 5.775 million. And our fourth sub-period starts right after this cash flow and the value was $6 million. This sub-period came to an end right before this cash outflow and the value was 6.72 million. Our fifth sub-period started right after this cash outflow and the value was 6.12 million. And this sub-period came to an end at the end of 4 quarters. So the value was 5.508 million. So we have 5 sub-periods and we need to calculate the holding period return for the sub-period. So for the first sub-period, there is no change in value. So the holding period return is 0%. For the second sub-period, it is 20%. For the third, it is 5%, 12% and negative 10%. Let us link all these holding periods. 1 plus 0% is nothing but 1 multiplied by 1.2 multiplied by 1.05, 1.12 and 0.9. We should get the time weighted rate of return to be 27.01%. The second question is to calculate the time weighted rate of return for the super trust account. Super trust account is responsible for managing 10 million of the entire pension fund. So I want you to calculate the time weighted return for the super trust account. You can pause the video and solve for the question. You should get the time weighted rate of return as 26.02%. Now let us look at another example. We are required to compute the investment performance of the Wallbright fund for the most recent year. And the facts are as follows. We should compute the Wallbright fund's time weighted rate of return. I want you to go through this information and solve for the time weighted rate of return. The answer to the question is 21.03%. This is the time weighted rate of return. The second question. You also need to compute Wallbright fund's money weighted rate of return. Before you solve for the money weighted rate of return, you should know this fact about IRR. Say you have a 1 year period and you have cash flows occurring at the end of 6 months. So we have CF0 over here, CF1 and CF2. So we have 2 periods. Each period is of 6 months. So when you enter the data into the calculator, you get IRR for the 6 months period, that is IRR per period. And if you want to annualize the return, you take 1 plus the IRR and square it and subtract 1, and you will get the money weighted rate of return for the entire year. So IRR is always per period. In our case, we have cash flows occurring at the end of 4th month and at the end of 12th month. So we have unequal periods. So we create an additional cash flow at the end of 8th month. Because there is no cash flow over here, the cash flow at the end of 8th month will be, we will enter it as 0. So we have CF0, CF1, CF2 as 0, and we have CF3. So now we have equal periods where each period is of 4 months. When you enter the data into the calculator, you will get the IRR to be 6.28%. This 6.28%, the IRR is for 4-month period. Now if you want to annualize the return, you will take 1 plus the IRR, raise it to the number of period, which is 3. Subtract 1 and you will get the IRR. So the main point here was to demonstrate that IRR is always per period. We are done with the 4th section, which was time weighted return and money weighted return. Now let us move on to the 5th section, which is annualized return. Until now we have seen annual compounding, where interest earned during the year was compounded in the immediately next year. But now we will look at non-annual compounding, where the interest earned will be compounded on a semi-annual basis, quarterly basis, daily or a continuous basis. Until now what we have seen was, say I invested $100 and I earned 10% during the year. So the interest of $10 was also reinvested in the next year. This was annual compounding. So I could say the interest that I earned was 10% per annum compounded annually. Now let us see what if we have 10% per annum compounded on a semi-annual basis. So I invested $100 and the rate is 10% per annum. So the interest rate per period, that is interest rate for 6 months, will be 5% and 5%. So the 100 invested initially will earn 5% and the value at the end of 6 months will be 105. On this $5 interest, we will again earn an interest of 5%. So the value at the end of year 1 will be 110.25. Similarly, when we have 10% per annum compounded quarterly, the interest rate or the interest earned will be compounded 4 times in a year. Say if I invested $100, then the interest rate per period will be 2.5%. So at the end of first quarter, I will earn 2.5 as the interest. The value will be 102.5. On this 102.5, I will again earn an interest rate of 2.5%. So the value at the end of the second quarter will be 105.0625. Similarly, this entire value gets compounded for the next quarter, and the value we get here will get compounded for the next quarter. So the value at the end will be 110.37. So as you can see that as the compounding frequency increases from annual to semi-annual to quarterly compounding, the value received at the end of the year also increases. This is pretty intuitive, as our interest, which was getting compounded just annually, is now compounded every quarterly. So this 10% per annum compounded annually or compounded semi-annually is the stated annual rate or the quoted interest rate. And the effective interest rate that we earn on an investment is, when it is compounded annually, we earn simply 10%. When it is compounded semi-annually, the effective interest rate that we earn is the difference between the ending value minus the beginning value divided by the beginning value, which is 10.25%. And in case of quarterly compounding, it is 10.37%. So these are the effective annual interest rate, and these are the quoted or the stated interest rate. Now let us see how can we find the present value when we have semi-annual compounding or quarterly compounding. So when we had annual compounding, say the future value was 110. So the present value will be 110 divided by 1.1. Now say we have semi-annual compounding where the future value is 110.25 and the interest rate is 10% per annum compounded semi-annually. In such case, the present value will be the future value of 110.25 divided by 1 plus the interest rate per period. Interest rate per period is 5%, so we will take 10 divided by 2, raise it to the number of periods. We have 2 periods over here, so this will be the present value. Similarly, in case of quarterly compounding, we have 4 periods and interest rate per period is 2.5%. So the present value will be 110.37 divided by 1 plus interest rate per period, which is 2.5% raised to the number of periods, which is 4. So this is the formula for the present value calculation. Let us look at an example on the next slide to understand it in a better way. The manager of a Canadian pension fund knows that the fund must make a lump sum payment of 5 million Canadian dollars 10 years from today. She wants to invest an amount today in a guaranteed investment contract so that the fund grows to the required amount. The current interest rate on GIC is 6% per year compounded monthly. How much should the fund manager invest today in the GIC so that the amount at the end of 10 years grows to 5 million Canadian dollars? So this is the case. At the end of 10 years, the fund manager requires 5 million Canadian dollars. The interest rate is 6% per annum compounded monthly. So what is the present value? So to calculate the present value, we take $5 million, which is our future value, divided by 1 plus interest rate per period, which is 6 divided by 12, raised to the number of periods in a year, which is 12, multiplied by number of years, which is 10. So you should get the present value to be 2748163.67. So this is how we calculate the present value when we have a non-annual compounding. We have looked at annual compounding, semi-annual compounding, quarterly and daily compounding. Now let us look at a special case of compounding, which is continuously compounded returns. In this scenario, the interest earned gets compounded on a continuous basis. That is, the interest gets compounded every second, every millisecond. Suppose I invested $100 and the interest rate is 10% per annum continuously compounded. So what is the future value? This is the stated annual interest rate or the quoted interest rate. Let us find the effective interest rate. To find the effective interest rate, we take exponential of the interest rate, which is 0.1, multiply it by number of years, which is 1 in our case, and subtract 1 from it. On your calculator, you press 0.1 and then press the second key and the ln key and subtract 1 from it. And you should get 10.52% as the answer. So when the quoted interest rate is 10% per annum, continuously compounded, the effective interest rate is 10.52%. So the future value is 100 plus 10.52%, which is 110.52. This is consistent with what we have seen, that as the frequency of compounding increases, the effective interest rate as well as the future value also increases. So when we had annual compounding, the effective interest rate was 10%. When we had semi-annual compounding, it was 10.25%. When we had quarterly compounding, it was 10.37%. And now when we have continuously compounding returns, the effective interest rate is 10.52%. Now let us look at one interesting property of continuously compounded return. In continuously compounded returns, the addition of each continuously compounded return of each holding period gives us the end value. Let us understand this with an example. Suppose I have 2-year investment period. During first year, I earned a return of 10% per annum compounded semi-annually. And during second year, I earned a return of 12% per annum compounded semi-annually. So let us find out the holding period return. That is the return I earned during the entire 2-year period. So I will divide each year into 2 periods because we have semi-annual compounding. So each period I earned 5% in the first year, and in the second year I earned 6% during each period. So the holding period return will be 1.05 multiplied by 1.05 multiplied by 1.06 and 1.06 minus 1. This should give us the holding period return of 23.88%. Now let us see if instead of semi-annual compounding, if we had continuous compounding, say I earned 10% per annum compounded continuously and 12% per annum compounded continuously. So to find the interest rate I earned during the 2-year period, I will simply take the exponential and add first year's return and second year's return. That's it. And I will subtract 1 from it. And I will get 24.61%. You can see that when we had semi-annual compounding, we needed to multiply each period's return. But when we had continuously compounded return, we simply added each year's return and we took exponential of it. So this is one desirable property where we add each continuously compounded return of each holding period to find the end value or to find the holding period return. Consider an example where I have two investment 1 and investment 2. Investment 1 I held it for 6 months and investment 2 I held it for 4 months. On investment 1 I earned a return of 7% for the 6 months and on investment 2 I earned a return of 6% for 4 months. Now if I want to find out which investment gave me higher return, then simply comparing 7% and 6% is not appropriate because both the investment have different investment period. So we have to bring them on the same page. We bring them on the same page by annualizing the returns. How do we do that? For investment 1, we assume that for the remaining 6 months also, we will earn 7%. And for investment 2, we assume that for remaining 2 4 months period, we will earn 6% and 6%. So the annual return here will be 1.07 multiplied by 1.07 minus 1. And the annual return here will be 1.06 multiplied by 1.06 multiplied by 1.06 minus 1. So the answer is 14.49% for investment 1 and 19.10% for investment 2. Now we can compare both the investment and say that investment 2 has performed better. But one limitation of annualizing the return is we implicitly assume that we will be earning 7% for the next 6 months or 6% for the next 2 4 months period, which might not be the case. So this is one limitation of annualizing the returns. Annualizing return facilitates ease of comparison between different investments when the investment are held for different periods. And this is the formula for annualizing the returns. In our example, in the case of investment 1, the interest rate for the period was 7% and there were 2 6 months period in a year. So we raised by 2 and subtract 1. Similarly, in investment 2, the interest rate for the period was 6% and we had 3 4 months period in a year. So we raise it to 3 and subtract 1. Now suppose if I earn 0.2% for a day and if I want to annualize it, then I will take 1 plus 0.2%, raise it to number of days in a year, which is 365, and subtract 1. If I have earned 2% for 1 week, then I will take 1 plus 2% and raise it to number of weeks in a year, which is 52. Now suppose if I had earned 3.5% in 7 weeks, then the annualized rate of return will be 1 plus 3.5% raised to number of weeks in a year divided by the number of weeks for which I held the investment for, which is 7, and we subtract 1 from it. Similarly, if I held an investment for say 5-month period and I earned 2% during the 5-month period, then the annualized return will be 1 plus 2% raised to 12 divided by 5 minus 1. Now what if I held an investment for 18 months, that is 1.5 years, and say I earned 19% during the 18-month period? In that case, the annualized return will be 1 plus 19% raised to number of months in a year divided by number of months for which I held the investment for, which is 18 in this case, and we subtract 1 from it. So this is annualizing the return. Let us look at an example. An analyst seeks to evaluate 3 securities which she has held in her portfolio for different periods of time. So she has 3 securities, security A, B and C. On security A, she earned a return of 6.2% for 100 days period. Security B, she earned 2% for the 4 weeks period, and security C, 5% during the past 3 months. We are required to compare the relative performance of the 3 securities. So security A's annualized return will be 1.062 raised to the number of days in a year, which is 365 divided by 100 minus 1. B's annualized return will be 1.02 raised to 52 weeks divided by 4 minus 1. C's annualized return will be 1.05 raised to 12 divided by 3 minus 1. So the answer will be 24.55%, 29.36% and 21.55%. So when we annualized each security, we can say that security B has earned higher return. I want you to solve this example by yourself, and if you had already solved this, the correct answer is option B. We are done with 5th section. Moving on to 6th section, other major returns and their application. This is a pretty small section, and in this section we will be discussing the following return measures: gross versus net return, pre-tax versus after-tax return, nominal versus real return. The first measure of return, which is gross versus net return. Gross return is the return earned by the manager before deducting management expenses, admin expenses, that is, the administrative expenses, and other expenses not directly related to the return. However, trading expenses like commission paid to the stock exchanges, brokerages paid to the brokers should be deducted to arrive at gross return, because these expenses are related to return generation. Net return is then computed by deducting all the management expenses and administrative expenses. Portfolio manager's performance, therefore, should be evaluated before deduction of management and administrative expenses. Gross return is therefore considered an appropriate measure for measuring the skill of a portfolio manager. The second measure of return, pre-tax return versus after-tax return. In general, all returns are quoted as pre-tax nominal return. That is, no adjustment has been made for tax and inflation. Suppose you have earned a return of 10%. This is your pre-tax nominal return, and the tax you need to pay is 20%. So your after-tax nominal return will be 10% multiplied by 1 minus 20%. So you retain 80% of your return, which is 8%. This is your after-tax nominal return. After-tax nominal return equals to pre-tax nominal return multiplied by 1 minus the tax rate. The third measure, nominal return versus real return. Earlier we have seen that nominal risk-free return equals to real risk-free return plus the inflation. Now after considering risky premiums like liquidity premium, maturity premium and default risk premium, we have nominal return equals to real return plus the inflation. These return account for the risky premium. They no longer are risk-free. This formula is an approximation. The actual formula is 1 plus the nominal return equal to 1 plus the real return multiplied by 1 plus the inflation premium. Suppose I earned a return of 12%. This is the nominal return and the inflation is 4%. So the real return that I earned on the investment is 1 plus the nominal return, which is 1.12 divided by 1 plus the inflation premium, which is 1.04. This gives me 1.0769. We subtract 1 from it and we get 7.69% as the real return. This is the return that the investor earns effectively after the inflation is adjusted for. Hence we can say the after-tax real return is what the investor effectively earns. Let us look at an example. Let us return to example 8. After reading this section, Mr. Lowerman decided that he was not being fair to the fund manager by including the asset management fee and other expenses because the small size of the fund would put it at a competitive disadvantage. He learns that the fund spends a fixed amount of 500,000 euros every year on expenses which are unrelated to manager's performance. We are required to estimate the annual gross return for the first year by adding back the fixed expenses. If you remember that the value of the fund at the beginning of first year was 30 million euros. And during the first year, the fund earned a return of 15%. This is the net return. So using the net return, the value of the fund at the end of first year will be 30 million euros plus 15%, which is 34.5 million euros. Now we will add back the expenses and the value will be 35 million euros. Now let us calculate the gross return. We take 35 million euros, subtract 30 from it divided by 30. Subtract 1 from it. And we should get the gross return to be 16.67%. This is consistent. The gross return is always higher than the net return. You could also do it in a different way. You take the fixed expense of 500,000 euros, divide it by the initial value of the portfolio, and you will get 1.67%. So this is fixed expense as a percentage of the initial value of the portfolio. And you add this to the net return of 15%. You will get the gross return of 16.67%. The second question is, what is the net return that investors in the Green Valley Superior Fund earned during the 5-year period? The net return for the first year is 15%. For the second year, it is negative 5%, then 10%, 15%, and for the fifth year, the net return is 3%. So you take 1 plus year 1's return, multiply it by 1 plus year 2 return, and so on. It is the same as the holding period return. You get 42.35%, and this is your holding period return or the net return. But if instead of net return, if gross annual return was given, then we were required to subtract the fixed expenses from the gross return to arrive at the net return for each year. Then multiply each year's net return to get the net return for the 5-year period. But luckily, we are directly given with the net return for each year. Third question, what is the after-tax net return for the first year that investors earned from the Green Valley Superior Fund? Assume that all gains are realized at the end of year and taxes are paid immediately at that time. Mr. Lohrmann expects to pay 20% tax on the return he earns from his investment. So during the first year, the return was 15%. This is pre-tax net return. To find the after-tax net return, we multiply this by 1 minus the tax rate, which is 20%. Hence, the after-tax net return will be 12%. Fourth question, what is the after-tax real return that the investor would have earned in the fifth year? In the fifth year, the fund earned a return of 3%. This is net return and this is pre-tax nominal return. We are required to find out after-tax real return. So first, let us find the after-tax nominal return. It is 3% multiplied by 1 minus the tax rate of 20%. We get 2.4%. This is our after-tax nominal rate. Now let us find out the after-tax real return. It will be 1 plus the after-tax nominal return of 2.4% divided by 1 plus the inflation premium 1.02 minus 1. We will get 0.39% as the after-tax real return. Let us look at the fourth measure, which is leveraged return. Leverage refers to the situation where investors purchase an asset using some of their own money and some of the borrowed money. Leverage amplifies both gains and losses to the investor. Suppose an investor purchases an asset for $100 and he sold the asset for $110 after 1 year. So the interest he earned is 10%. Now suppose instead of investing his entire money, he invested just $70 of his own and borrowed $30. So let us find what will be the return in this case. At the end of year 1, the investor will receive $110 and he has to repay the $30 that he borrowed, and we also subtract the $70 that he invested initially divided by the money that he invested, which is $70. So we get a return of 14.49%. This is the return that the investor earns on his own money. So as you can see, when there was no leverage, investor earned only 10%. But when there was a leverage, investor earned a return of 14.4% on his own money. Now let us say if the value of the asset fell to $90, the return is negative 10%. This is the case when the investor invested his own money entirely. Now instead of investing his own money, he borrowed $30 and invested $70 of his own. The return in this case will be $90 minus 30 minus 70 divided by 70. In this case, investor earns a return of negative 14.49% on his own money. So leverage amplifies gains as well as it amplifies the loss. Now consider that the investor has to pay 5% as interest rate on the money that he borrowed. So the interest rate that he earns on his own money will be 110 minus the $30 that he has to repay minus interest of $1.5 minus 70 divided by 70. So the investor earns a return of 12.14% on his own money. You won't be tested much on the numericals. It is enough if you know the concept. Let us look at an example. An analyst observes the following historic asset class geometric returns. For equities, the geometric return is 8%. For corporate bond, it is 6.5%. For treasury bills, it is 2.5%. And the inflation is 2.1%. The return on treasury bill can be considered as risk-free rate. We are required to compute the real rate of return for equities. It is 1.08 divided by 1 plus inflation, which is 1.021 minus 1. This should give us the real rate of return 5.88%. Option B is the correct answer. Question number 2. Compute the real rate of return for the corporate bonds. Just like we calculated it for the equities, in the similar way we can calculate it for the corporate bonds. And the answer will be 4.3%. Question 3. The risk premium for equities is closest to. The geometric return of equity is comprised of risk-free return plus the inflation premium plus the liquidity premium, default risk premium and the maturity premium. In order to find out the risk premium, we need to subtract the risk-free rate from the equity's return in order to get the risk premium. So the risk-free rate is 2.5%. Therefore, the risk premium will be 8 minus 2.5. But a more appropriate way to calculate this will be 1.08, that is 1 plus geometric return of equities divided by 1 plus the risk-free rate, which is 1.025. We will get 5.4% as the answer. Similarly, for corporate bonds, we get the risk premium to be 3.5%.